Retail sales this week looked pretty solid, a good revision for the holiday shopping period, but it has been a bit of a game of winners and losers within the sector. Tom Light's looking at options with us. Zach Waring joins us from CFRA Equity Analyst, who's covering a couple of the big ones. It seems like Amazon, Walmart, Costco has been basically the only three you need to think about. Zach, tell me what you guys are seeing in the group.
Yeah, so overall, really good holiday season. You've got the good retail sales report over the last few months. November and December basically up 4% year over year. So again, better than expected across the board, really. And that's just been the story of the U.S. consumer. I mean, they've just been willing to spend, and kind of, many analysts and investors thought by now, maybe that savings would be gone and you'd see some struggle in retail sales, but you just haven't seen it. We really like, the big box retailers. We think you really can't go wrong there. We think that's where a lot of the U.S. consumers are shopping. But then, there's other categories within retail that we really like. We like names like Abercrombie and Fitch. They're at a discount right now. We believe shares have plenty of room to run. We upgraded them to a strong buy this morning. But you can't go wrong with the Walmarts, the Targets, and the Costcos.
Yeah, it's just gobbling up, I guess, the kind of middle of America at this point, the places that folks thought maybe e-commerce wouldn't quite fully penetrate?
Yeah, over the holiday season, you continue to see discounts, driving sales. So, Cyber Week was obviously the biggest week again, made up the majority of the holiday sales. Cyber Monday being the biggest day of the year for retailers. So, another winner was, online and e-commerce. Again, you kind of see that shift to online. You're seeing a little bit of a shift to buy now, pay later, which is, growing pretty significantly year over year. I think it was up 10% this year, according to Adobe. And so, you're seeing, a lot of companies now, Walmart's spending a lot on their AI to kind of help them. And you're kind of seeing that first with the bigger, the companies that are able to spend more. So big box retailers are up front there. And then again, you've got the off-price retailers that are doing well. So overall, a really good holiday season. I think, all the retailers have benefited from that. And, biggest beneficiaries are online retail and then, the big box.
How do we get bang for our buck in your sector if we want to express a view on the strength of the economy, resilience of jobs, stocks possibly breaking out again, and that discretionary income staying strong? Is there any particular brand or store that you feel is underappreciated the most?
Yeah, I led the show off talking about Abercrombie. I think Abercrombie's a name. They trade at 12 times analyst estimates, for next year or this year. Which is, well below their 3 and 5 year average. The company has proven over the last 2 years that it's, putting out the right products. They're marketing really well. They've been able to grow sales and EPS pretty significantly over the last 2 or 3 years. And you've got a little bit of a down, over the last few weeks. It's, you've seen shares drop pretty significantly, trading at the bottom of the range. And we just don't see any way that this falls through that bottom of the range. We think there's a bounce around the corner.
All right. It looks like a pretty great technical entry point if you believe that the range at least holds. I didn't realize that the chart was set up that way at this point. It's a pretty interesting one. Back and forth, basically since August. So love it. Thanks, Zach. Appreciate it.
Thank you.
Yeah, good thought there in Abercrombie. Tom, you're going a little bit more of a tried and tested and assured.
Mainstream.
Yeah, Amazon and Walmart.
Yeah.
Let's go magnificent first. Amazon, what you got?
They got earnings on the 6th of February, so that's going to be a catalyst. Kind of want to avoid that. Looking at the option market, does the stock get back to those all-time highs of about 233 into that earnings event? This has been named a top pick by analysts across the board here. So the momentum's still to the upside. It's still above its 50-day moving average, which has been a good base case here. So if you think the stock's going to rally into earnings, and typically we'll see a lot of price target hikes going into that. Zach mentioned the fact that retail sales over the holiday shopping season were really robust. That's a positive for Amazon. And then the cloud side of their business, AWS, continues to perform well. So I looked at a strategy that avoids earnings but takes advantage of over the next 2 weeks, the stock moving higher, maybe back to those all-time highs. So I looked at an unbalanced call butterfly here in the January 31st weekly series, so 14 days to expiration, where I'm going to buy one of the in-the-money 222.5 strike calls, sell two of the 235 strike calls, and then buy one of the 240 strike calls. So that unbalanced or broken wing call butterfly to the upside where I can offset some of my costs, where I think it's going to go up, but it doesn't have to explode to, above 240, above 250 for me to profit on this one. If I'm paying a debit of roughly about $3.70, that's going to be my risk. It's maybe trading around $4 right now, but the debit you pay is going to be your risk on it. If I pay $3.70 debit, it takes my break even up to $226.20 over the next 2 weeks. That's less than 0.5% above the current share price in Amazon. So you don't need that explosive move to the upside. You can see here from the risk profile, the apex of profitability right at or near that 235 strike, but anything above that break even, just above 226 is going to be profitability on this one. And you lower your input cost by doing the butterfly as opposed to buying just maybe the 222.5, 235 call vertical. So you're lowering your input cost, which lowers your risk.
All right. I like that. Get into it for a pretty high probability and ride the wave basically. For Amazon.
Grind higher is what you need.
Exactly.
Up another $10.
Not too ambitious. Yeah. All right. What else we got? We got Walmart.
Yeah, Walmart, maybe, the stock's up nearly 70% over the last 12 months. It's had a great run. They've executed pretty well, and the consumer's still out there spending. That's a bonus for Walmart as they beat down all their competitors in this space. So it was a little bit more conservative on this one. If you want to own the shares, maybe this is a long-term holding, right? Well, let's do a look at a covered call strategy that takes advantage of the move higher, owning the shares, and that allows you to collect that dividend. Now the stock has rallied nearly 70%, so that dividend yield has come down. It's only about 0.9% at this point, but this might be a long-term hold. So for every 100 shares of stock you buy in Walmart, I'll look to sell one of the February 21st monthly options that expires in 35 days, sell the 95 strike call that's currently out of the money to the upside. You're paying roughly about an $89.90 debit on that one. So you're buying the shares at about 1.7% discount to where the stock is trading because you sell that upside call. Now that caps your gains, but at the same time, we're just below all-time highs here that we hit $96 in December. So your gains are capped, but at the same time, as you get closer to February expiration over the next 5 weeks, you'll be able to roll or adjust that short call, creating more credits. That lowers your break even, increases your potential profitability. And this is a paid-to-wait type strategy, Oliver. You're still bullish, but you're moderately bullish or conservatively bullish while taking advantage of yield on the short call and the dividend.
Nice. Like it. Solid trades for solid stocks, for a solid consumer. Thank you, Tom White.
Yep.